Public scrutiny has increased on executive incentives generally, but especially in the springtime. So what are the hot topics that investors are focused on? So ESG and climate focus are both rapidly developing areas and are making their presence felt through the medium of the investor. ESG and performance measures now form the most common non-financial performance indicators for annual bonuses and long-term incentives. In disclosures, investors are seeking a better explanation of how executive remuneration and chosen performance metrics are aligned to the company's purpose, value and strategy, rather than a statement of it's just linked. Investors now expect a little more flesh to disclosures, and if peers are used as a comparator, that should be specifically and clearly disclosed. As regards the operation of discretion, this is now becoming more acceptable by investors. Any exercise of discretion should only ensure the outcomes of executive pay schemes properly reflect overall corporate performance and the experience of shareholders, and in addition, the general market environment. Again, this is about adding a bit more colour to disclosures made in relation to the activities of remuneration committees, how they operate, and the various powers that they have in relation to incentives. When it comes to malice and clawback, this should apply in a more substantive range of cases rather than just gross misconduct and financial misstatement. So remuneration committees should establish a list of specific instances and some specific triggers that would apply. Key point here is that investors are increasingly looking for more substance. They're really expecting more information and justification from companies as to why particular incentives and arrangements are set out the way that they are. Looking to the year ahead, we can expect investors to increasingly scrutinise executive incentive arrangements, both through the lens of the broader workforce and stakeholder groups.